This was supposed to be a panel conversation with a moderator, but we now have what's called a fireside chat. And so we're going to be asking each other questions. I can start off. My name is John Vessa, Managing Director of the Harbor Group at Morgan Stanley, Wealth Management. I've been involved in the SPAC space since 2005. So over 20 years of being involved with SPAC trust funds, cash management, and over that time frame, have advised about 140 SPACs and close to $30 billion worth of SPAC assets. So pretty experienced. On my left is Carrie Savio. I will let her introduce herself.
Thank you, John. So Carrie Savio, welcome everyone. I'm a partner at Weaver in the audit practice. Weaver is a national accounting firm with audit, advisory, and tax services across the country. We are very happy to be here. This is our first year at the SPAC conference, so thrilled to be here and look forward to meeting many of you between tonight and tomorrow.
Tony?
Hi, my name's Tony Dietrich. I'm with BNY Dreyfus. BNY Dreyfus, we manage about $450 billion in short-term liquidity assets. This is our first time sponsoring at the SPAC conference, so excited to be here and looking forward to meeting many of you tonight over cocktails.
Great.
So as it was mentioned, we are the last presentation before drinks and dinner. So we're going to make this snappy. Hope you get something out of it. It was mentioned that this is the first time that cash management has been a topic of conversation. So when I thought about putting this together, I thought that this would be an opportunity for new SPAC sponsors to kind of understand what the different bank accounts are, cash flow, what the importance is of each account. And the thread that runs through the three of us is that we all touch, at some point, these cash management accounts. So I think there's a thread that makes this all make sense. Before I go into kind of an introduction, I think our attorneys and compliance people would like me to mention that we have disclaimers, and my disclaimers are on page 86 of the conference guide, and it basically says that this is an educational conversation. We're not speaking about specific investments, and there are risks involved which you will see in those disclaimers. So what are the bank accounts that are involved with a new SPAC? Well, typically, a SPAC sponsor needs to have a SPAC sponsor LLC account where you deposit risk capital and receive loans from the sponsor if necessary. And that's used for the formation expenses of the LLC, for certain filing fees, for legal and accounting retainers, and those types of expenses. The other type of account that is necessary is an operating account, and that account is for the corporate entity. That account will pay for the search expenses, will pay for the D&O insurance, further legal and accounting fees, administrative, rent, any of the expenses that are needed to actually eventually find and merge with the target. So I guess my first question to Carrie is, how important is it to have good delineation between all those upfront expenses from an audit standpoint?
Great question, John. Yeah, so from an audit standpoint, we are going to want to make sure that all of those expenses are supported with invoices so that we can audit them, make sure that they are valid business expenses, and then also make sure that they're properly classified on the income statement based on their expense type.
Okay. So when we're called in with a new sponsor, it's usually from an attorney working on the issuer side, or perhaps an underwriter. and they'll ask us to speak with the new sponsor and kind of explain what the trust fund is all about. And it's a simple concept, but the trust fund is really one of the most important aspects of a SPAC because it's really the protection for the investors. And there are requirements as to what types of investments are allowed in a trust fund, what types of disbursements can be made from that trust fund, who runs the trust fund, who's responsible for it, and who are the various players. So I can start off by saying that when I explain that to a new SPAC sponsor, I explain it in this way. It's a triangular relationship. We're the investment managers. You are the source of the cash, the sponsor of the company, and the trust company, which has the fiduciary responsibility to manage the trust assets. And it's set up that way so that you do have maximum protection for the shareholders, because keep in mind, this is a new company. There are no assets except the cash in the account. There's no business yet, and it's important to have those protections. So what are the permitted investments in a SPAC trust fund? There really are only two. One are treasury bills, basically 6 months or less in maturity, or U.S. money market funds that comply with Section 2A7 of the Investment Company Act, and that only invest in direct government obligations. So with that, I'll turn it over to Tony with a question. Tony, talk a little bit about the difference in the various types of money market funds, and why is it that this specific type of money market fund is only permitted in trust funds?
Absolutely. So there's primarily three types of money market funds that are available to institutional investors. One being prime money market funds, which invest in commercial paper primarily, which drives the return. And then they're coming down the risk spectrum, government money market funds, which invest in treasury, government securities, and repo backed by those instruments. And then further down the risk profile, which is where we typically see SPAC investors utilize money market funds, is 100% treasury funds, which are funds that invest in treasury securities and do not have access to repos. It's strictly treasury securities that are managed in a pooled vehicle. And as John mentioned, they are governed by Rule 2A7, which is the SEC rule that governs all money market funds in the industry.
So what are the requirements that a fund has to go through to be 2A7?
So
the 2A7.
So there's three main principles that any money market fund and manager has to adhere to. And first being preservation of capital, two being liquidity, and three, kind of the furthest, being yield. And what 2A7 does is it really mandates the liquidity and the types of securities that can be purchased in these portfolios. And they are the highest of credit, that offer the highest liquidity. And as an example, just from the 2A7 regulation, where it's mandated that a money market fund have 10% daily liquidity and 30% in weekly liquidity, and they're mandated to have 60-day weighted average maturity in their portfolio. So the mandate really is to have high quality and securities that mature and that are highly liquid. And for a SPAC investor, when you need to draw upon those balances, you need to know that you can have that same day liquidity. And these instruments are also $1 NAV. So given that they're able to use amortized cost accounting, they maintain $1 NAV, so it's dollar in, dollar out, and the interest accrues daily and is paid out on a monthly basis.
Thank you.
Yeah. So if I could just interject from a accounting standpoint. So with these investments that we're talking about, you just want to make sure from an accounting standpoint that your CFO and controller have devised an investment policy that's documented, and then your auditor will audit that via confirmation with the bank. And then also make sure that you have adequate disclosures in your financial statements that would eventually be filed with the SEC.
Good. How do the auditors ensure or make sure that the company is only investing in permitted investments?
Yeah, so that's going to be come back to again confirmation of those receivables with the bank. So we would look to confirm those outstanding cash balances as of the end of the reporting period. So if it's a December 31st year end, those confirmations would be sent as of 12/31 and be received back to the auditor directly from the bank.
Great. So who actually, and this is a question for me, who actually is responsible for choosing the investments in a SPAC trust fund? Well, it's not us, and it's not the trustee, it's actually the sponsor. Sponsor signs an investment trust agreement with the trustee that outlines each party's responsibility, and it's really up to the sponsor to choose the investments that they want in the trust fund among the permitted investments. So what are the types of issues that sponsors may come up with? When we talk to sponsors, previously, back in the old days, it was very typical for a sponsor to initially go into a trust fund with the longest dated U.S. Treasury bill that they could buy, which is around 6 months. Because the likelihood was that they weren't going to find a target and need to liquidate that T-bill before the first 6 months. And then after that point, we would have another conversation. Okay, how far are you away from needing the investments for your combination for the closing? And typically that could be another 3 to 6 months. And we would either roll T-bills forward or at some point go into a money market fund. These days, it seems that what we're seeing is that many more sponsors are utilizing money market funds for the liquidity or shorter dated US T-bills. We haven't been really going into 6 months for quite some time. But did you want to talk a little bit about kind of the differences between those two?
Sure. I mean, I think from a money fund standpoint, it really is the active management and the ability to provide that same day liquidity. The operations of the money market funds, it's just less operationally intensive than a managing sort of a treasury portfolio would be. And then there's the added risk. John, you talked about potentially having to call on those assets earlier than expected. Depending on what the market dynamic is, you don't want to sell that and take a net loss potentially in any market. So the Treasury money market fund allows for that same day liquidity and that peace of mind, where if you need to call the assets earlier than expected, you're going to get your dollar for dollar principal back.
So, Carrie, we receive many audit requests during the course of working with a SPAC, and sometimes the audit requests come in and they need to be done very quickly.
Yes.
Because of a closing.
Deadline, closing, yep.
Because of a filing, and so what kind of time pressure should we be aware of from your perspective, and how can we help you?
Yeah,
do your job?
That's a great question. So I think coordination, and I think this has kind of been a theme today, right? Coordination, making sure that the audit firm and management and the bankers and the lawyers and the advisors are all coordinated real time, because a lot of these deadlines and filing, it comes quick. And so making sure that we're coordinated up front and getting those confirmation requests and whatever other documentation we need from the bank directly is well coordinated, is important.
Who actually is responsible for signing the confirmation?
Well,
And does it matter to you?
the bank needs to sign it, and also management needs to sign it. They need to authorize the bank to send the confirmation back to the auditor, but the bank is responsible for signing that and then sending it back to us, the auditor, directly.
Yeah, and we often have to get the trustee involved with that as well.
Yes, that's true.
Okay.
Yeah.
So Tony, talk a little bit about the safety of money market funds and perhaps what has happened in the past that's maybe affected liquidity. As an example, during the financial crisis, have any money market funds ever lost money?
Well, there was one fund, the reserve fund, that technically broke the buck, so it did maintain the dollar NAV. But that was a prime money market fund. We've never seen that happen in the government or treasury space. And to be honest, in times where there's choppiness in the market or there's something happening in the market, money market funds tend to be a flight to quality. So what you've seen, whether it's the financial crisis or during the pandemic, you've seen large influxes of cash into government and treasury funds for investors, it's seen as a safe haven for investors during those times in the market.
So in a trust fund, at least 90% of the proceeds of the IPO need to be deposited in the trust fund. Is that something that you audit when you take a look at the accounts?
Yeah. Yes.
Yes.
Yes. That's something that we'll take a
Okay.
look at. Yep.
All right. What types of allowable expenses usually are allowed to be deducted from the trust fund? So what types of expenses can come out of the trust while it's in existence? I can answer that.
Yeah. Why don't you answer that for
All
me?
right, so I'll ask
Go
myself
ahead.
the question.
Yes. Thank you. Yes. Good.
Basically, no other expenses, no expenses for finding a deal, no administrative expenses. Most S1s do allow for income taxes to be taken out. So during the life of that trust fund, those funds are extremely well protected. And they have to be because at the end of the day, whether there's a deal or not, whether a target is found or not, investors have the ability to redeem their cash. And as Mitch said this morning, the redemptions are a little bit better now than they were, but you're still talking about 70, 80% redemptions from the trust fund. Talk a little bit about the valuation, Carrie. What issues around valuation? Is it for targets? Is that what you?
Yeah. So the valuation on the financial statements of the company itself, it's going to depend on how highly liquid those investments are, and how quickly they can be converted to cash. So your money market accounts are typically stated value. Longer term investments, there just needs to be an investment policy, and then there's some specific accounting guidance around when those would be recorded at fair value versus cost. And the auditor would test that as part of the audit testing that gets done.
Okay, thank you.
Sure.
I've been asked at times what's been the most difficult time period for SPACs since I've been working with SPACs. And it was during that 2021, 2022 period where there was just so much activity. We were getting calls sometimes the day that the cash was available from the trust company. And so I always like to tell people that I'm working with when I'm speaking to attorneys or underwriters to please bring us into the process early on. Opening a trust account is probably the easiest aspect of the early on procedures for a SPAC. We open a trust account really the same day. There's no KYC for a trust account. All of our KYC is already in-house. All of our documents are already in-house. as opposed to opening operating accounts. We're sometimes asked by a sponsor, hey, can you open our sponsor account? Can you open our operating account? Is that the same process as opening a trust account? And the answer is, it's not the same process because it's a bank account that requires a lot of KYC. It requires formation documents. It requires source of funds for the signatories to the account. So those types of accounts actually could take a week or 2 weeks depending upon the availability of the documents that are available. When I look through S1s, Carrie,
Yes.
I see a lot of verbiage about going concern.
Yes.
So what are the going concern issues that are important to consider?
Yeah, so this is just, I guess, taking a step back to define what a going concern is. The auditor has an obligation and the company has an obligation to evaluate the company's ability to continue as a going concern for 12 months from the time the financial statements are issued. And so what that entails is looking at cash forecasts and budgets and making sure that the company has enough liquidity to survive as a business for the next 12 months from that date of financial statement issuance. And so making sure that the investments are in those short-term investments that Tony was discussing earlier, and you have access to cash and those investments are easily liquefied is really important. And to the extent that it's determined the company is not able to continue as a going concern, the auditor's report would be modified as a result, and the company would be required to put some additional disclosures into their financial statements.
So I keep seeing questions about, can a SPAC be considered an investment company? And why is that a concern? Tony, you want to speak a little bit about that?
I don't know that I've heard that one, so I may kick that back to you.
Okay, so this is actually something that I think was much more prevalent, in the heyday in 2021, 2022. The SEC came in. There were some issues where SPACs exceeded their 18 to 24 months. They kept going on, and the longer a SPAC goes on, the greater the danger that a SPAC can be construed to be an investment company. And why is that a danger? It's a danger because if you're an investment company, there are a lot more rules and regulations and expenses to comply with that. So, what are SPACs doing these days to avoid being construed as an investment company? Well, one of the things that I've seen in S1s is that there's language in the S1 that basically says, hey, investor, this is not an investment company. You're not investing in us, just for the income return. You're investing with us because of the possibility of buying a company in a combination. The other thing that I see is that, the other criteria is that the money in the trust fund is not meant to be actively managed. It's not something where we are asked to continually trade a portfolio, come out of treasuries, go in the money market fund, change the maturities. Sponsors are keeping things very quiet, keeping things very simple, and that's why we've seen many more SPACs really now go into money market funds, because it's kind of a one-stop shop. The yields on money markets are very competitive with treasuries. These days, the treasury yield curve from 1 to 6 months is very flat. So there's really not much of a distinction between money market funds and treasuries. But sponsors have that additional comfort that they're not managing the portfolio as an investment company, that they are getting a very competitive yield, and they have that liquidity. They're not worried about, hey, what if we have to sell a treasury before maturity. And hey, what if there's a situation in the world where rates spike, a debt crisis, and that's why many SPACs are using money market funds now.
Great.
Anything else from you?
No, nothing else from me.
Oh, really?
Yeah. No, I think it's about the ease of use. You touched on it here, but that's really as a SPAC issuer, the money market funds really makes it easy. The availability, the liquidity, and the peace of mind that it brings. So, yeah, I would agree with you in that regard, and just continue to see that activity in the money fund space.
Fantastic. I'd like to open the floor if there are any questions.
Oh, I don't think
Got a
that.
question?
Maybe.
Somebody should have a mic somewhere.
Yeah, there should be one. I don't know. Come on up.
Why don't you come over here then?
Just in light of your comments regarding the switch of SPACs to money market funds generally, the two questions. One, when do you recommend, I know you recommended getting an investment manager involved early on in the transaction process. Could you guys go a little bit more into the role of the transaction manager and what they're doing in terms of helping the SPAC sponsor regarding management of trust funds?
Sure. Well, that's my role. So what we do, as I mentioned before, is we have a triangular relationship. It's ultimately the SPAC sponsor's responsibility to choose those investments. So when I'm brought into the conversation, I'll explain what the permitted investments are. I'll explain how opening the trust account works, what the relationship is between us and the sponsor, between us and the trustee, and between the sponsor and the trustee. So initially, we may talk about, hey, these are what the 1, 2, 3, 4, 5, 6 month T-bills are paying right now. They may ask, or I may provide some color as to, where do we see interest rates going over the short term? Do we think rates are rising, falling? What's the Fed doing? We'll have that conversation. We'll talk about money market funds. What money market funds are paying? Are they competitive? And then we'll come to an agreement with the sponsor based on the information that we provide the sponsor. They'll agree on what investments they would like going in. We then provide them with an investment letter which documents that, and they send that to the trustee, and that gives the trustee the authorization to basically authorize us to purchase the investments and hold them on their behalf.
The investment policy that Carrie mentioned, is that something that's the investment policy that you mentioned, Carrie, is that something that's an actual document, or is that kind of an understanding between the investment manager, auditor, and the trustee?
Yeah, from my perspective, I was just stating that from an accounting policy standpoint, you want to make sure that you've got those investments documented so that the policy with respect to it is auditable. And then you can set up those controls that are necessary in year 2 of being a public company around making investment decisions, and also proper segregation of duties and approval and authorization and all of that with respect to it.
Okay,
Yeah.
great. Thank you so much for your
Sure.
your
Thanks
time.
for your questions.
Again, in terms of the SPAC, if you already have the companies to buy, all you need is the money to buy them with. Or I can buy them in advance, cut a deal, and then determine how much to pay them in cash later, if they want cash. But if I do the SPAC and I bring the money in, I can deploy that money. The question is, can I deploy that money for other purposes to grow the company?
I think,
As opposed to buy the company.
Did you understand the question?
I do not.
Okay. Are you asking about what what cash is available to the target company at the. I'm sorry, I couldn't hear your question.
Okay, if I get the money from a SPAC,
And you're the target company?
no, I'm the guy buying the companies. I already bought them on paper. Therefore, I own them.
You're
Now
buying
I
a
do it-
company not through a SPAC.
I'm buying 5 or 10 companies.
Okay.
I already have them. I cut a deal to own them. Now I take the SPAC money in. I go a SPAC route. I take the money in. Now I can either give them some capital in cash, or I can deploy that capital. Or I'm asking the question: can I deploy that capital to improve the operations of those companies, given their technologies, whatever? Or
Yeah, I
do I
think
have to use it only to buy the companies?
Well, I mean, you are going to be able to, in some cases, have cash that goes into the new company that they are using for growth. So it's sort of like a private equity. If you're a private equity shop and you approach a candidate, one of the things that they're looking for is operational expertise, but also financial backing to promote growth in the company. So it kind of depends upon how much cash is left. You know, what we talked about before is that 80-90% of the cash in the trust fund usually goes to those investors that are redeeming. So what is the cash coming in at the end? It's coming in from pipe money.
Well, the question I would ask is, why are they redeeming? Didn't I just get the money?
Oh, why are investors redeeming?
Yeah.
They have the ability to vote on the deal. Maybe they are not.
Okay. So
it feels not as promising.
Okay, so when the transaction occurs, if they don't like what we're going to do with the money, they can pull their money out.
Oh, they absolutely can.
Okay, all right.
80-90% are, these days are pulling it out.
That would be detrimental to what I want to do.
Yeah, absolutely. Thank you. Thanks for the question.
All right.
Any other questions? Well, thank you very much for your attention. We appreciate it. Thanks for being here. Let's have a great dinner tonight and some cocktails.